for Chartered Accountants. We have our speaker for today, Mr. Ravi Prakash Gandhi from Mumbai. And to begin proceedings, I request our chairman of Ernakulam branch, CA Jose KV, to give the welcome address.
Thank you, Tony. Most beloved Ravi sir from Mumbai and our MC members, Deepa Vice Chairperson, Tony, who is coordinating today's this online meeting, other senior members and friends in CA fraternity who is joining online from Ernakulam as well as outside Ernakulam. A warm good afternoon to each one of you. So today we are very happy to host a CP seminar on Insolvency and Bankruptcy Code 2016. We know that it's one of the new code or law. Rather, many chartered accountants are, taking it as IP professionals under this and doing a lot of work for resolution of many matters. As we know, the Insolvency Bankruptcy Code is meant for resolution of matters, relating to insolvency and bankruptcy within a reasonable time frame. I think that is very important. We can, finish all this procedure within a reasonable time frame. That is the intention, basic intention. But practically, there are many hurdles. Even for I am not IP, but as a for a client, I have applied for as an applicant for resolution process. But it took a lot of time, taking much. Maybe the eminent speaker will elaborate on that. But the advantage or the benefit is, of course, it's immense, because before some cases the debtors are settled before NCLT is admitted the cases, and the statistics say that there is 2.84 lakh crores rupees are settled before admitting the case to by the NCLT. So, and of course, it shows that it saves, entity which are, funded to the organization which is going for the insolvency, and it saves lower the burden of the creditors, and also it improves a lot of. If you look at the economy of nation as abroad, it saves, it improves that, and the bankruptcy code is in that way very important and very relevant at this point of time. And today, our speaker Ravi Prakash Gandhi from Mumbai will be talking about the various opportunities for CA. As we know, many members are IPs practicing, doing that, the IP insolvency professionals as insolvency professional. But apart from that, what I understand, there are many opportunities for chartered accountants. Even the going concern, we are talking about the entity shall be managed in such a way that it should be there as a going concern, because the IP take it charge and they conduct the business as normal business, and there are many duties or roles an IP has to do. But these IPs need not be a chartered accountant. But running a business, I think, other than chartered, other than any other IPs, other than chartered accountants, running a business can be handled by chartered accountants. So what I understand, even from the Ravi sir also, that there are many opportunity for chartered accountants to run the business as a going concern basis, because that need not be an IP, but a chartered accountant can do that. So there are many opportunity. I'm sure today it will be a great learning for all of us here. So I welcome our eminent speaker for this afternoon, Mr. Ravi Prakash Gandhi from Mumbai. On behalf of Ernakulam branch, all the members, I cordially welcome sir to this CP seminar.
Thank you, Mr. Jose. Thank you very much.
And I welcome our MC members, chairperson, vice chairperson Deepa is here, and Tony Varghese, who is coordinating today's program. Welcome both of you, as well as I welcome all the senior members and our friends in CA fraternity who joined on this online program. So once again, I welcome all of you, and other few guests also joined from outside Kerala, outside Ernakulam. I welcome each one of you to this CPE seminar. Back to Tony Varghese for further proceedings.
Thank you, Joe, sir. Now, ladies and gentlemen, I take the privilege of introducing our faculty member for today, Mr. Ravi Prakash Gandhi. He's an insolvency professional and the founder director of Resolve International Private Limited. He has a wide and intensive experience of more than 35 years across various industry sectors, such as consumer durables, industrial components, seafood, and chemicals. He has functional experience in marketing, purchasing, production and quality, finance, HR, legal, and compliance in large listed companies. He has held board or CEO level positions in 2 listed companies. Currently, is a liquidator of 9 corporate debtors in real estate sector and advisor to liquidator and RP in 3 separate matters. So he has completed his BTech honors in metallurgical engineering from IIT Kharagpur in 1979 and his PGDBM from XLRI Jamshedpur in 1981 with specialization in marketing and finance. And it is a pleasure to know that he is still a student at this age. He is an LLB final semester student today. And his specialized knowledge is in business process reengineering and theory of constraints. He's a regular faculty in IBBI's pre-registration course for IPs and IIPI EDP course for IPs. So, ladies and gentlemen, please welcome our faculty member for today, Mr. Ravi Prakash Gandhi. Over to you, sir.
Thank you very much, Mr. Jose, Tony. Thank you so much for your very warm words of welcome. Okay, I don't have too big a presentation, but I will be covering all the salient points, and I would like it to be as interactive as possible. I'm perfectly fine with anybody wanting to ask a question in between. Just use that raise hand symbol, and we will recognize you. So, Tony, please enable everybody that if they want to intervene and ask a question, even in between, I am okay with it. Okay?
It's on, yeah.
I'll start with the. Okay. Is it visible on the screen?
Yes,
yes. It's visible, yeah.
Thank you. Okay, so what we are covering today is briefly about the Insolvency and Bankruptcy Code 2016. I'm making the assumption that many of the participants today are not necessarily IPs. So very, very briefly, I will run about the background on how this code came about. I'm not going to go into technicalities of that because that will be very detailed, but just the background to understand what is new or what is different about IBC. And then we will focus on during the CRP or liquidation process, what are the roles or opportunities that are available to chartered accountants who are not necessarily IPs. Okay, a bit of history, history lesson. Always it's good to start to know how we arrived here. And before we even look at the history, let's see at what is insolvency. I mean, how is it defined? Now, there are 2 broad definitions of insolvency which are available throughout the world. I can say that one could be called as net worth insolvency, where the value of the assets is significantly lower than the value of the liabilities, which means that in the short or medium term, the company or the which is not unlikely to be able to meet all its liabilities in a going concern manner. So that's net worth insolvency. And that is how the basis on which SICA and BIFR were actually formulated. Those of you who have dealt with SICA and BIFR would know that the reference to BIFR was at first stage when 50% of net worth gets eroded and then when the entire net worth gets eroded. So it was a net worth based insolvency situation. IBC is different because that is the second type of insolvency, which is called cash flow insolvency. Here, it is possible that the value of assets are adequate to meet all the liabilities of the company, but the cash flow is not adequate to meet the liability when the demand comes or when the liability becomes due. And that is what IBC is based on. Now, the history of insolvency laws in India, the oldest two laws largely dealt with individual insolvency. These were the Presidency and Provincial Towns Insolvency Acts of 1909 and 1920, respectively. The jurisdiction was with the High Court or the district courts, depending on which. For the Presidency Act, it was the High Courts, and for Provincial Towns Insolvency Act, it was the district court that was jurisdictional. These acts are still on the statute books. They have not yet been repealed, but they will be repealed in due course once all the provisions of IBC 2016 get notified. But as of now, that act still stands. The Presidency Provincial Acts, as I said, primarily dealt with insolvency of individuals and partners, but not so much of corporate insolvency. And that was the domain of the Companies Act. All the Companies Act, right from 1913 Act, 1956 Act, 2013, they all had provisions which dealt with insolvency. So there are two types of provisions in that. One that we are very familiar with is the winding up proceeding, which is basically liquidation. And the office of the official liquidator would handle that. There was also within the act, at different times, different acts had different types of provision, which dealt with restructuring or resolution, whatever name you want to give it. The 2013 Act had an entire chapter on it, actually, which got repealed once IBC came into force. But in addition to that, there were what you would call provisions relating to compromise or with the creditors, scheme of arrangement or compromise with stakeholders of the company. Now, those provisions still exist. The 56 Act had it, and even today, the 2013 Act, Section 230, 31, 32, they deal with that part. Now, if you look at the provisions of the Companies Act of Section 230 and all that, you will find that the scope of that provision is actually much wider than IBC itself. But the procedure is so long and complicated, and it is not time bound as such that nobody really prefers it. Hardly anything gets done as far as Section 230 is concerned, except probably the most commonly used situation is when you want to do a capital reduction. Other than that, 230 really is not used so much. Now, after the Companies Act came SICA, and through its enforcing arm, so to say, was the BIFR, Board of Industrial and Financial Restructuring. And we know what SICA went. In 1985, it came in. SICA, the BIFR was called as a one-way door, that once you go in and you remain there, nothing happens. It was a haven for promoters who wanted the protection of law from enforcement of their liabilities, but could escape without doing anything at all in terms of either a resolution or restructuring. While SICA was a sort of a general law for all companies, that and it triggered on the basis of net worth insolvency. It's not that somebody could take you to BIFR. You had to become eligible to be even making a reference. So it was that the cause of action, in a way, had to be the entire erosion of the net worth of the company, which itself tells you that how flawed the position was, that if you wait for the entire net worth to be eroded before the law looks at you or considers you to be a patient, it is like saying that unless you stop breathing and the heart stops, you won't even look, the doctor won't even look at you. And naturally, it was bound to fail, and that's what happened. Parallel to this, based on the demand from the banking fraternity, banking financial institutions, another act got enacted in 1993 that was earlier known as the Recovery of Debts Due to Banks Act. It got amended to FIs got added. That is why it's called RDDB FI later on. Today, it is called Recovery of Debt and Bankruptcy Act, which is a very confusing term that we have two bankruptcy acts together. But primarily the RDBA or RDDB, as we more familiarly known, dealt with the recovery processes by banks and financial institutions. And the forum for that was the Debt Recovery Tribunal. The DRT is a creation of this act, uh, not Companies Act, but RDDB is the one which created this forum called the Debt Recovery Tribunal. The name itself says that it is all about recovery. How is recovery different from resolution? We will just come to that also. There is a very, very fundamental difference between the two. Now, RDDBA, while it was there and DRT was created, but we are very creative people, especially from the borrower's side and those of us from the legal fraternity. We know how to find every loophole. And if it is not there, we will create one. So even the RDDB became largely a failure. And you say failure in terms of the expectation. The recovery under the Civil Procedure Code or the recovery under RDBA was not really that much significantly different to be saying that, this, okay, now we have some sort of a solution. Didn't happen. Again, based on a lot of demand from the lending fraternity, primarily secured creditors, who said that even the DRT is a forum common for all, secured, unsecured, everybody. It's slow. It takes its time. It gives stay orders like that. We want a mechanism where, as a secured creditor, as is possible in many other developed country jurisdictions, that we should be able to enforce our security interest on our own without the intervention of court. Such provisions exist in the CPC and Transfer of Property Act also, but very difficult to implement as such. They wanted a separate law for that, and that is how the SARFAESI came up in 2002. In SARFAESI, basically it is that any secured creditor, as defined under the Act, would straight away enforce the security interest either by taking over that asset and disposing it off, taking over an undertaking of that borrower and selling it or managing it, selling it, whatever, changing the management of the company itself, which is what IBC does, right? IBC changes the management. But that provision was there even under the SARFAESI Act. But the legal system was such and continued to be for so long that enforcing even SARFAESI was not easy. The success rate was found to be much, much less than what they had actually expected. And so many hindrances coming up, basically because, one, the banks had no infrastructure or resource or even experience on how to go about taking over a company and managing it. That just didn't exist. There was no body of professionals or a pool of people or resources on which they could fall back upon, that if they want to enforce this RFC, how will they go about it? It was just not possible. But taking all this into account, then the BLRC, Banking Law Reforms Committee, was formed. It sat for quite a bit of time actually, but compared to other committees, much faster. And then they came up with this BLRC report, which recommended a few very, very major things. One, it said that the insolvency regime the management of that should effectively be privatized by creating a separate registered body of professionals called the insolvency professionals, who will be regulated in turn by the IPAs, that is the insolvency professional agencies, and overall under the regulation or the regulator of IBBI. So this is one thing they said. Second, they said corporate insolvency and individual or firm insolvency need to be looked at differently. So there should be two separate forums where the proceedings will be admitted, adjudicated, and basically decided upon. They also recommended that it shall be largely a summary process. It will not be an adversarial process of all the rules of evidence, etc., but very, very specific trigger points on when one can apply, when it will get admitted, what will happen, strict timelines. Okay. The actual timeline under IBC, which is the desire, is 180 days, extendable maximum to 270, then became 330. Then, of course, with so many other issues that we have, there are cases which are going on for 3-4 years too. But that apart, the idea is to achieve that sooner or later. And another major change came. They said, okay, we will get away from this net worth concept of insolvency, and we will go to something else, a trigger which will initiate the process of insolvency resolution sufficiently in time so that something really can be done about that corporate debtor and not wait till it becomes dead. So the concept of default in, default in payment. So any default of any debt, subject to the limits, earlier used to be 1 lakh, it is 1 crore now. But any default of that amount will enable the creditor to initiate the process. Now, who can initiate it? They said, okay, there are 3 categories of persons who can initiate the IBC proceeding, the corporate insolvency resolution process. One is a financial creditor. Financial creditor is defined. Largely, we understand them to be banks and financial institutions or anybody who has lent money for time value of money. The second category of people who could initiate it is the operational creditor. Now, operational creditor is defined as somebody, a person who has supplied any goods or services to the corporate debtor and a default of that payment has happened. Operational creditors, they said, would also include workmen, it would include employees, and it would include the appropriate government to whom money is due by way of any law in force. Now, what we have to understand here is that every money due to a government body is not money due to the government. Okay, so the sovereign function and non-sovereign functions have to be distinguished. But either way, they also can initiate a pre-RP proceeding. Okay, till today, no, I don't think any government body has done that, but the enabling provision is there. The third category was the company itself. In fact, the objective, though not very explicitly stated in the BLRC report, is that going forward, it should be the company itself which should initiate it. And they should realize it themselves as a borrower that, yes, we are likely to get into trouble. We have had one default, but it can be much more in future. And if we do not restructure our, what do you call, the financial system, that is the loans, etc., and the entire financial package on which the company runs, then as a company, we could get into more trouble going forward. We could even close down. So it is like where the patient decides that he needs a doctor. Okay. Not that he waits for a doctor to call him and says, okay, you come here, or somebody else or an AA. So the section 10, which is what covers the powers of a company itself, the borrower itself to apply, is intended to be the one which is hopefully the maximum used in future once all the legacy backlog cases of insolvency are settled. How far that will be successful, we don't know. We have a, what you call, an ecosystem which thrives on finding loopholes and finding ways out of how not to follow the law. So the jury is still out on that, whether that will happen, but that is the intent of the regime. Any questions till now? Anybody wants to ask? Please go ahead. I would welcome.
You can go ahead, sir.
Okay. We have no questions as such till now, sir. You can go ahead.
Okay.
Okay.
Right. Okay. And now we are talking of the BLRC report. I mentioned that briefly, that it emphasized that the resolution shall be the preferred option rather than winding up or liquidation. another major change, which the reports which has come into IBC is the creditor in control. Now, under SICA, it was always debtor in control. That is, the management continued to be in control of the company. SARFAESI enabled a creditor in control regime, but it required an action to be taken by the creditor using their own resources on whatever experience or people or infrastructure that they have. But the IBC has created a different regime, which will enable a creditor in control by first creating the IP and then, of course, the committee of creditors. So the regulated pool of insolvency professionals. As I said, that the administrator, that's what used to be called under Companies Act or in other regimes, what we call as an IP. That office of the administrator, in effect, has got privatized. That means people will be private individuals who go through the qualification process and get themselves registered, can act as court-appointed administrators. In the Companies Act scheme, it was always the official liquidator who was attached to individual high courts. There was the scheme of appointing receivers who could be private individuals, but mostly used for recovery type of process. Nowhere for administrative. There have been instances where the company law board or the government intervening it have taken over companies for a short period of time, managed it, and then got out of that. Satyam is, of course, the most recent celebrated case of that, where the CLB, the government through the CLB, took over the management of that company and got it sold off. The event of default is the trigger for initiating a corporate insolvency resolution process, okay, not net worth. The net worth could be hugely positive, but as long as there is a cash flow default, then IBC starts. Independent regulator, this is of course the IBBI, who will register and monitor the professionals, frame regulations. Now, IBBI is a unique regulator in the sense they regulate the people. They also frame subordinate legislation. It is modeled somewhat on SEBI in a way that there are a lot of commonalities in the structure and the way they function, the SEBI and IBBI function. And the advantage of having an independent regulator, in addition to expertise that they would develop in that chosen area as compared to ministry departments, would be the quick response. That since they deal with only one type of subject and common type of situations, they would be able to monitor what is happening in the market to whatever is already existing in terms of laws or processes, and then respond quickly by making any amendment, circular, clarification, etc., which they have done. I mean, IBBI has been, one can say, super fast in responding to changing market demands or needs or issues that they have recognized in the system. Dedicated tribunals, that NCLT for corporates, DRT for individuals and firms. As of now, DRT is partly functional under IBC, only with respect to personal guarantors, but now some judgment has come that one can directly approach NCLT also. But these are the two forums that would be operating. Strict timelines, a summary admission process, which means that the admission of a case under CIRP, and Supreme Court has clarified here that the tribunal has to look only at two things. One, is there a debt, a legal debt which is recoverable by the applicant? It has a default happened of that date? Then a limitation, obviously, that it is within the period of limitation, and it is above the threshold level, which is 1 crore today. That's it. Once these things exist, the tribunal is not expected to go into the merits of the case at all. Right? Who was at fault? Why did it happen? The sun was shining too bright. It rained heavily. Floods came. Fire happened. Nothing matters. That is what the law says. that it's a summary process. 2, while it starts as a proceeding in personam, that means there is one creditor who is initiating the process. The moment it is admitted, it becomes in rem. That means against the world at large. So that's why it is not called a recovery process. Recovery is always between two parties, the one to whom money is owed and the one who owes the money. It is between them. It's called in personam, right? Between two people. It could be two or more. There could be 2-3 people jointly filing it or separately. But in rem means doesn't matter who starts the process. Once admitted, it becomes common for all. And there is no specific or special role anymore for the applicant. The applicant ceases to effectively exist as a separate person and becomes one of the claimants once he has filed the claim. And that is what the process is. Liquidation under winding up under Companies Act is also a proceeding in rem. Once admitted, it is against the whole world. There were other objectives of IBC, of BLRC, one of them which is promoting the bond market. What is this promoting bond market? The idea is to encourage corporates, the good ones, maybe the ones which are doing reasonably well or whatever, to move away from taking loans from the banking system and going for private funding by way of bonds. Bonds usually are unsecured, but could be secured also. And because this objective is there, the Committee of Creditors under CIRP does not distinguish between whether the creditor is a secured creditor or an unsecured creditor. At that stage of decision making, everybody is equal, only the differentiation being on voting power. So the bigger claimant has a bigger voice in deciding on how the proceeding will be tackled in terms of sanctioning expenditures, cost, or approving resolution plans itself. The IBC supposed to enable a structured and quick exit. That if it comes to the conclusion that this business is better off closing down, then it should offer an easy exit process also. Exit in the Indian context was nearly impossible in the earlier regimes, and one could try for years and years and years and not succeed. But now the nation has realized that businesses fail. More fail than succeed. That for every 100 that start, maybe 90% or more are likely to fail. So the entrepreneur should be allowed to exit from whatever he has started in a quick and easy manner, rather than wait endlessly for achieving nothing in the end. So, and this in turn will lead to ease of doing business, the ease of doing business ranking. And another major change, which is difficult for any country to do, where the government said, yes, our own dues, which always used to rank high, because crown dues before everybody else, that was the concept, that we will take it below the financial creditors. And that not just secured financial creditors, but unsecured financial. So today, under the section 53 of IBC, the ranking of government dues comes after unsecured FCs. Above general trade creditors, but after unsecured FCs, which is a very significant change and not easy for any government to easily give up that power. Okay, so we have covered two parts of the background, what were the laws of insolvency prior to IBC, and what was the BLRC report about broadly, the major salient features of that in terms of the enactment of the Insolvency and Bankruptcy Code 2016. And now we will look at what is of interest to chartered accountants who are not necessarily IPs. And I have tried to put this in a chronological manner in the way in which the opportunities come up when the process starts, a case gets admitted, starting with after admission. So when a Section 7, 9 or Section 10 petition gets admitted and the corporate insolvency resolution process gets triggered by order of the NCLT, one of the first things that happen is that a moratorium is announced on any recovery action by any creditor against the company. And second, interim resolution professional gets appointed to manage the company. The board of directors, the powers of the board of directors get suspended, and all the managerial powers now vest in the IRP. Now, what does the IRP do? Okay, very, very strictly laid down tasks that the first and foremost thing within 3 days of appointment is to put out a public announcement inviting claims. Claims from whom? From all creditors, all types. Any claim on the company by anybody, private, public, government, whatever, all have to file claims as per that. The IRP also takes custody and control of the assets of the company. The IRP is supposed to take over the management of the company and manage it as a going concern. Now, going concern, one caveat here, that it is not expected that something which is dead, the IRP will revive. That's not possible. The company has not, for example, been running for 3 years, 4 years, or even 2 years, and doesn't have cash for running, doesn't have people, doesn't have customers, whatever, or machinery is not good enough, the product has become obsolete for whatever reason. The IRP is not supposed to be a magician, but the IRP shall not make things worse than what they were when he takes over. I mean, that is the minimum expected. There are a significant number of cases now coming up where the companies are actually operational. They may be partly operational, may not be full capacity utilization, but they are still operational. And so the concept of managing as a going concern has validity as far as that is concerned. So the IRP makes a public announcement, takes charge of the management of the company. Now, what does he have to do? Even if the IRP has a finance and accounting background, either as a CA or anything, it is not possible that one person will be able to do everything. Okay, look at all aspects of the CRP process per se, then look at the overall management of the company, and in addition, also look very deeply into the specific finance and accounting function. So this is one area, depending on what is available in that company, what type of existing resources are there, plus the degree of trust or faith that the IRP has on the people that are already available, that the managing the accounting and finance function becomes a very critical part of the managing as a going concern for the IRP. And this is where people with the skill, knowledge and qualification in terms of the accounting and finance functions, basically chartered accountants, CA firms, individual CAs, this is one significant opportunity for them, that as a CA, individual or a firm, you can look at this as an opportunity where you tell the IRP community that I am available. I know how to tackle this part of it for a short-term period, which is 6 months, 9 months, whatever. And I will be able to take care of this entire accounting and finance function so that you as the IRP can focus on the resolution side. Okay, that's the whole idea, that you offload some functions to people who are better equipped to deal with that. So that is one right in the beginning, because this opportunity comes from day one effectively. So it is at the IRP stage itself that this opportunity becomes available. The second one is now related to the public announcement that claims come. Now, claims have to be verified, and sometimes that can be a huge task for the IRP. in terms of number of claimants, if it's a larger company, there could be hundreds, even thousands of claims that come. So the entire paperwork, the supporting data, understanding that, okay, in terms of whether the claim has been made rightly, is the principal amount correct? Is the calculation of interest, if any, done properly? Is it in line with the loan documents that have been there? Have any payments made by the corporate creditor been accounted for or not accounted for? All these things, because you have to verify the claim as an IRP based on the claim document submitted and the records available of the company itself. Now, the records available in the company are not necessarily up to date always. They may even be incomplete. And in cases where the company is not in operation and people are not readily available, you may not have any records at all. And then it becomes a really Herculean task to be able to verify and admit those claims. Now, not admitting is not an option because anybody can say no. So the court will look upon that very, very, adversely. That if the IRP goes back and says, what can I do? There are no records in the company. I can't verify a single claim. Then say, okay, we don't need you to say that. Everybody knew that. So how does the IRP do that? Now, this is where the skill comes in. The skill of having dealt with such task. Now, this is verification is one type of an audit function ultimately, because when you do audit of companies, you do verify at least on a test basis some of that, and this is what you as a chartered accountant know how to go about it. And so this is a significant opportunity where a chartered accountant individual of firm can offer the support to the IRP in the claim verification. Now, I have used the word assisting very deliberately because strictly speaking, the IRP is to do the verification on his own. So he can't outsource it. So he can't say, oh, they did the verification. I don't know how they did. Now, that is not. So the chartered accountant helping the IRP is only a helping hand and not taking the responsibility. So you are not doing it as an auditor that you sign and say, oh, yes, I have verified. So no signature part is neither required nor even allowed in the claim verification process. But this CA or the CA firm becomes a resource available to the IRP, a skilled and experienced resource, which can do this job very well. So that is what the opportunity is, that assisting the IRP or the RP in claim verification. The next big part, and now this is the tricky part, which comes to avoidance transaction. What is an avoidance transaction? In the code, it is defined as preferential, undervalued, fraudulent, or extortionate. Okay, extortionate is a rare occurrence, but we all understand what a preferential transaction is, that A is paid in preference to B when B should have been paid earlier. That's straight away, simple way of saying preferential. Undervalued, yes. If something worth 100 sold off for 80, undervalued. Okay. Not 99, because that would be a matter of judgment, but significantly where any reasonable person can say one should have fetched or sold it for a higher price. Fraudulent, of course, not for the company and not for the benefit of the creditor, but for benefit of somebody else. So somebody else could be the management, could be the promoter, could be third party, where the management itself is not knowing about the transaction, but some employee also indulges in it. That would also be a fraudulent transaction. Now the code casts a responsibility on the IRP or RP, primarily RP, because this is after the IRP stage, that within a certain specified period of 75 days, the RP has to come to a prima facie opinion that yes, this company within the past look back period, now look back period is 1 year for non-related party transaction and 2 years for related party, has been subject to either a preferential or an undervalued transaction. Of course, if it is fraudulent, there is no minimum look back period because it's considered criminal. So as many years back as we want. Now that is the first step, to come to a prima facie opinion This is not a determination yet. It's not a decision making. It just looks like, okay, there is a possibility. Now that prima facie opinion again is a skill job. This requires knowledge of finance, knowledge of accounting methodology, commercial acumen, okay, and a bit of law as to what is preferential and what is not. And again, this is where those chartered accountants, again, who have, let us say, either a special audit experience or even general audit, but they have got this exposure or have the basic knowledge and skill to do that. They can assist the IRP coming to this opinion. It is now at this stage again, it is the CA is acting only as an advisor to the IRP. It's not a statutory role. It is these opinions are not evidence anywhere at this stage. They are just to. It's like a legal advisor. So you are, instead of that, you are a financial or accounting advisor who is telling, okay, which of these transactions seem to be something which needs to be looked into. So at this stage, so this is where a CA or a CA firm can assist the RP. In coming to that initial opinion, yes, there seems to be something wrong here. Okay, so that is. After having formed the opinion, suppose the opinion says, yes, there seems to be. Possibly at this stage, no conclusion has been drawn that it requires further investigation. Enough prima facie evidence to suggest that it could have happened. So let us look into it deeper. Now, looking deeper is a skill job. So this is where what we commonly call as transaction audit or forensic audit. This is where it comes. Now, at this stage, the appointment is nowadays by practice largely formal. That means the RP in consultation with the COC actually appoints a specific transaction or a forensic auditor. And here a report is actually generated, which has got evidentiary value. That means the RP and the COC can rely on that report and can also use it when taking it up as a legal proceeding in the NCLT. While the code, the IBC itself does not mention these words. It doesn't say that anything called a forensic audit, transaction audit, special audit, nothing, because it has left it entirely to the RP to come to the conclusion. Okay, prima facie opinion followed by determination. How the RP goes about that job has been left entirely between RP and COC, and by practice over the last 4 years, this is how they normally do it. That they appoint a transaction or a forensic auditor, who then looks into transactions for a particular period of time and then gives a report, a formal report. Okay. The next one, okay, that was we dealt with transactions of the avoidance nature, but now coming back to the real objective of IBC, which is not avoidance, but getting a resolution plan, getting the resolution. So there is the requirement that a resolution applicant, a prospective resolution applicant, should not be ineligible under any of the disabilities under Section 29A. Now, this also is a skill job. While the code does not say how the RP should go about it, has not even said that it should be a bulletproof type of forming of opinion. It has also said that reliance can be placed on an affidavit received from the PRA as well as material available on record. But when cases are large or sensitive, the practice has been that the 29A eligibility is actually checked professionally by the RP, either on his own or by appointing advisors or consultants who can do the job for it. And again, 29A is, while it has got certain legal disabilities, but largely they are related to money in one form or the other. NPA for a certain period of time, willful defaulter, disqualified director, etc. So another window of opportunity where chartered accountants are concerned, that this is something one can specialize in. It is a skill job. It requires a lot of what you would call desk research, so to say, that you need to look at various. Today, of course, we have internet search, and a significant amount of information is available. But one needs to know where to look for and how to look for it. It is not a general person's job. One needs to acquire not a skill and an experience, both, as far as this part is concerned. So this is another significant opportunity that chartered accountants have for in the IBC process. This is the one which, in my opinion, is not been looked at all till date. In the last 5.5 years, that wherever I have seen, neither the RP nor the COC even looks at this aspect, though they are supposed to look at it mandatorily and give a statement. Yes, we have assessed the resolution plan for its feasibility and viability, and then only vote on it. But it just becomes a bland statement, but nobody really looks at it. But this is actually the crux of everything. And more so when the resolution plans are not about upfront payment. See, when the acquirer is paying money upfront, the creditors are not concerned what they are going to do with it afterwards or how they want to run it, etc. They don't need to be, okay, because they are exiting from that portfolio. But when the payment is going to be in a manner which will go over a period of time, 1 year, 3 years, 5 years, it could even be in one case, the plan said payment over 20-year period. Then it is like as if giving a new loan or a restructuring, and then the feasibility and viability of resolution plan needs to be assessed. How is that done? Hardly anybody does that. But this is something which is likely to become very important in the near future. While I am not saying it will happen, but knowing past experience and history of humankind in general and our nation in particular, many resolution plans are likely to fail on this ground alone, that the feasibility and viability of that plan was not really assessed, neither by the applicant nor by the creditors. This is something which is going to be more important in future, though today not many people do it. In the CDR regime and other restructuring regimes, this was being done in that, they used to call it the TEV study, techno-economic viability. That's what it is. It's just new terminology. But while they were doing it during that time, nobody is doing it really now. But this is something which is possibly the most important part of the entire restructuring package. Okay. That we have covered all the substantive part of the opportunities that are available, but there are a lot of procedural work that the IRP or RP has to do, and quite a bit, which requires again that the IRP or RP may not have the infrastructure or resources within his own control or ownership or whatever, or his own firm. He might just be an individual who is good at his job but doesn't have the resources and doesn't need to have also. So this is where, whether it is related to compliance filings of the company, compliance filings of the RP, because RP also has to do filings, secretarial support in terms of conducting board meetings, all other MCA related filings, tax compliance, and advisory issues that come up, like any company will have issues that come up which nobody can really plan for in advance. And how do you tackle that? How do you tackle an income tax notice, for example, of assessment? Because assessment is not recovery and it cannot be stopped. It is just a verification process. So how does if the RP either does not have the experience or skill himself or doesn't have the time to do that, then there is another opportunity where experienced and skilled chartered accountants can give support to the RPR. Okay. So that sort of completed what I will call my formal presentation. So now the floor is open for questions. Please ask any question, anything, directly what was presented, even related to that, or anything that comes to mind.
You can use the chat option, or you can raise the hands and we can enable the mic.
Yeah, participants can post queries in chat box also, or question and answer box.
Yeah, just better ask directly.
Okay.
Yeah, you can raise your hands and we can enable your
Unmute.
mic so that you can speak.
Okay, seems nobody has any
Sir,
doubts.
yeah, one doubt, sir. This delay. See, there is any specific time limit for finishing all the insolvency procedures, like whether it can be prolonged, because what I find that even the corporate defaulter, who was the director, they are coming with a resolution plan. And they are saying, first they don't come, they come after some time, and even the NCLT allows. So is it against the principles of IBC? I mean, whether they can do it? I mean,
Okay, one is what the law states, the literal portion of the law. The second is the actual way it is administered. And we have this phobia in this country, entire nation, not now, it's quite 70, 80 years old, that we don't want a company to be legally closed. We don't mind if it is actually dead, but we don't want to give the death certificate. Okay, we probably think it is inauspicious to say it is closed. We are quite stupid. This is actually coming out of stupidity, decades of stupidity. That's why ease of doing business is so difficult. In India, that index, we are so low. If we can set up a company today within a day, can we exit in a day if we want to? Impossible. It takes a voluntary liquidation takes 2 years, where every creditor is paid in full, because you can't have a haircut in voluntary liquidation. Even then, it takes 2 years. And this strange thing that, okay, baad mein dekhenge, let me, and when it is not voluntary liquidation, but normal insolvency, and it has to go to liquidation. See, in 99% cases, or maybe 99.9%, I would go to that extent. During the first meeting of COC, the COC and the RP usually know that iska kuch nahi ho sakta, it has to go to liquidation. Do they do that? No. They will say, okay, let's try one more time. Okay, one more time, one more time. Now, this is a psychology issue. There is nothing to do with any, what you call, malafide reason or whatever. Even where no such thing exists, people still do not want to say, okay, band kar. What will people think? We have done liquidation in one day. How can we do that? So let us give one more chance. And maybe, liquidation, because it's such a final decision, it's the end of story. But the person giving the order might also be thinking, maybe I'm wrong. Maybe tomorrow somebody will come up and say, I could have revived it if you had only given me the chance. These things weigh on the mind of any forum. See, the judges change from day to day. The thinking of the institution as a mechanism has not changed. It still says, let's not go to liquidation. Now, Supreme Court also, you'll find in every order will say liquidation is the last resort, liquidation is the last resort. Now, compare this with the UK system. Okay, UK, the same insolvency law, which we have largely adopted. It's there now for 30, 35 years. Liquidation is the first option. They come to quickly to a conclusion. Is there life, or should we do give medicine? Should we put under ICU, or should we just give death certificate and isko kaat ke, do organ harvesting, which is what liquidation is about? Why waste time trying to revive a dead body? We have at least 70% cases, if not more, today in CIRP are companies which have not been operating for minimum of 3 years or more. How are they going to revive? They are not going to revive in that present avatar. Their assets may still have value. Now, there is a company which, let us say, manufactures textile, not operating for 10 years. Somebody comes and takes over that and then builds a township there. That is not CIRP. That land could have been sold even in liquidation and faster without all the headache of CIRP compliance requirements are higher than liquidation for an acquirer. For a person who wants to take over, liquidation is a far better option because it's a clean slate. You just take over the asset. Nothing else you are concerned with. CIRP, what about hidden liability? There will always be hidden liabilities. So giving this, so this is a psychology issue, why they keep doing it, why people, promoter wanting to take back his company at a fraction of the price is normal human greed. Everybody will do it. Okay. So we can't have a sit on moral judgment there. They will do it. That is expected. But should the court system look at that and give such long rope? Well, before we say that this is bad, we should just compare with what was earlier. In BFR, if something took 10 years, in IBC, it is taking 2 years. I think huge difference. At least BFR, nothing would happen. So while we have not reached the 180-day level, but we have on an average come to the 2-year level as compared to minimum of 10 years. So to that extent, it is 5 times better. And that's not a small achievement. That's a huge achievement. IBC achievement is huge. And as I think you were mentioning that even before admission, more than 2.5 lakh crore has been recovered by creditors. Now, would that have happened if there was no IBC? Today, the promoter of a valuable company is scared of IBC. As long as the promoter sees value in his company, he will not let it go. If the value has already been eroded, and that doesn't happen in one day, that happens over a period of time, 3 years, 5 years, 10 years, maybe. Then it's different. Then they give up, okay, you take over, because nothing is left. All the cream, juice, everything has been taken out, whatever had to be taken out. So such companies, when they come to IBC, the COC should have the guts to decide on day one, we will go for liquidation. And the NCLT should also accept that commercial wisdom and say, yes, they have looked at it, they have said it, so we should not interfere and put our wisdom there, because how much time does a member on the bench get to look at a case? Few minutes. Whereas the COC and RP are supposed to put significant time on that and come to that conclusion. So that conclusion should be given the respect it deserves. It will take time. We are getting there.
So we have a question regarding the startup. So what is the minimum time period that we can wind up a startup when they don't have any creditors? But still, earlier it used to take minimum, the company needs to be in existence for 2 years before you can go for voluntary winding up. Now the Honorable Finance Minister has proposed a fast track winding up, but is that applicable only for a recognized startup, or as a company, can it go into winding up in the first year itself? Or, when normally what happens with startups is most of them fail when there's a change in law or an impossible situation happens, then they can't proceed with that business idea. then the founders have the idea that we'll close this company down, but they have to wait for a few years without any activity going on. They have to continue with the compliance, everything before they can wind up. That is the situation now. Practically, is it possible for us to give them a faster exit?
Okay, I am not really an expert on the voluntary winding up, but one thing that, at least to the best of my knowledge, I don't think there is this minimum existence period in any law that I am aware.
Okay.
On practice, maybe, but
Yeah.
as far as my knowledge goes, there is no law that says that you have to be alive for so long before you can die.
Okay. Yeah.
Okay. Second, closure of a company. Voluntary winding up is not the only solution. There is a direct route under Companies Act called strike off.
Yeah.
Okay, where nothing else comes. I mean, it's a very purely procedural route where the ROC basically has to be satisfied. And then I think NCLT comes in the picture at some stage, but that's also possible. Voluntary winding up as such is where, let's say you have taken loan.
Okay.
Then you are liable to somebody, and that is when the law steps in. Suppose you have a company where you have put in your own shareholder money only, maybe whatever, 6 months later you come to the conclusion it's not working out. Something has happened, whatever it is, you want to close it. Now that doesn't really require on paper that much time. But between paper and practice in India,
Yeah, there is a difference.
that I don't think is anybody's control, because if anything that is made mandatory in law, Supreme Court immediately comes and says mandatory for you, not for me.
Yeah.
For me, it is directory. Me means the judicial system, because you can't impose such conditionalities on any judge anywhere, because that goes to the heart of the independence of the judiciary. So, what issue? I would say that okay, it depends on which forum you are there, where you are registered of. These things matter, right? But 6 months may कर सकता है.
Okay.
But it
We are
requires a
seeing
lot of effort.
Yeah, we're seeing cases where the application for liquidation is or being application for strike off is being rejected on the grounds that the company is too young, or the application. I mean, you have to wait for 2 years. Some sort of criteria is there. So companies, startups, basically with a age of like 1 year or so, the application is being rejected, even though they have no transactions in the bank account.
They agreed, but I don't know which law says that. I'm not aware of the law. As far as I know, there is no such requirement. But if the startup, for example, has taken some of the benefits of startup, it might be in that law, like the Income Tax Act might be putting a restriction. Okay, not under Companies Act. So it all depends on the situation of that particular company. See, people cannot come up and say, I have taken loan. Now I think 6 months later, I want to wind up and I don't want to pay anybody. Then one says, no, sorry, that can't be done.
Okay. Do we have any more questions?
You are giving CPRs for this, right?
Yes.
So let me give you a secret. There is a difference between login and attendance. If you have CPRs, you will have login but no attendance. If you do not give CPRs, you will have both login and attendance. I'm telling by experience. Wherever CPRs are there, login will be there, but most people are not actually listening. They're not even there. So if you say show an so-called attendance of 25, 20 would be pure login without even listening. Happens everywhere throughout the country. All IBBA programs, everything, wherever there is a CPR, that it is a disincentive to attend.
Has somebody raised a hand?
Please unmute, no? Tony.
I'm not able to see, but Satishan.
Yes.
So Shri Chata, can you unmute Mr. Satish and T?
Am I audible now?
Yeah.
Yes.
Yes, yes, yes.
Want to take this opportunity to say, meet everybody, number one. Also, more than the question, I also thought to make use of this platform to share some of the practical experience what we had, and possibly the potential for a chartered accountant to offer, services in CARP. See, my experience with whatever little I had in the CARP process is that by the time the CARP process starts, the good people have already left. If you look at the finance and accounts team, all those people who will be able to get a job at elsewhere, they all would have left. The people who left in the organization would be largely of two kinds. One, the promoter planned it, who would be the ears and eyes of the promoter or the erstwhile management team or directors, or the people who are not getting any other job. So you are left with a system which will be very difficult to manage. Getting the details, getting the data, getting the report in time, doing the statutory compliances with the team available with the corporate at that point in time. So this is where the point which Raviji mentioned, point number one, the managing accounts, which effectively the CFO service. By and large, 40% of the IPs are not chartered accountants. Out of the 60% who are there in the CARP assignment, he will be left with very little time on managing the whole thing. I'm talking about a going concern. I'm talking about a company which is generating revenue. I'm talking about a company which has got a life still left. So if you really wanted to manage the company of that kind for a period of anything 6 months or 9 months, you need to have the support of an effective team and F&A team, which is not available with the company, which you need to get it outsourced. That is where possibly very little thought has gone so far. What used to happen is COC is always very stingy. They will say I cannot approve budget for this. So then the IP will not take any initiative to getting it done. Result is what? Very, 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 very loosely controlled regime during the CARP stage with many deficiencies in terms of the compliances, which at a later point in time, both the RA and the erstwhile RP will have to face it. So creating an effective team during the CARP, which will be possible only through an outsourcing, and who best other than the chartered accountant, the practicing chartered accountants will be able to offer this kind of services. So at an individual practicing chartered accountant level and also at the chapter level, maybe little more thought need to go as to how effectively we can make use of this opportunity. So I thought let me share this thought and leaving it with the chapter on that.
Thank you, Mr. Satish.
Yeah, for the information, Satish sir is a chartered accountant. Is joining from Mumbai, who is a colleague of our Ravi sir. So thank you, Satish sir, for that kind words regarding the the CA. What we can do, we can help the way as part of the going concern concept. So I have one doubt. See, now we are taking over all the the entire assets and liabilities or the entire organizational business things. So is there any what is say any liability to the as a IP or as a chartered accountant involved in this? Like, see, the organization may fail again. Now it's going concern. But suppose because of many factors, any organization, any establishment, not only on sales, there are many factors which affect the continuity or success. At least we have to keep the establishment for such a long period, continuity as a going concern. So, what are the responsibilities? Is it anything like which affect our I mean, will it there be any liability on our side.
You're talking of the downside, the potential claim that could be made or an action taken against
Yeah,
the
we cannot. We
The
cannot
RP is
meet
protected by law. The RP is protected by law. The IBC itself. Okay. So the legal protection is complete for the RP. All actions taken in good faith during the process of CIRP or liquidation, uh, where the RP is functioning either with the RP or liquidator, is completely protected. No one can file any proceeding or make any case in any court anywhere in the country against the RP. If they have a grievance, then the only way out is to make a complaint to the IBBA, which will look into that matter within the procedure that they have for such things, and then decide whether to take it forward or not. IBBA has a lot of options on what to do. It can carry out an inspection. It can do nothing, saying that there was nothing, no substance to the complaint. It can just give a warning. It can levy a financial penalty. It can suspend the registration or even cancel the registration. It can even file a criminal case against the person, and in this special court designated for that. But it is only the IBBA that will decide. No complainant can decide. So any party can at best go and file a complaint with IBBA. Now this is the law. So this is the legal protection. Not necessary that on the ground it will be followed. Like we know of the case where people have got arrested. Okay. Now, this protection does not extend to criminal activity. Now, if the person as the IP, either during that process or in a completely unrelated matter has done something, he's not going to be protected. The police or CBI can arrest him for that part of it, which is a crime under law. But no civil action can be taken, or no police interference on a matter which is otherwise civil, like a cheating or something, which is related to the performance of the duty, cannot be done. But if there is an allegation saying that this person took away so much money from the company, so that is crime. That will be. So the law is there. If you ask, is it adequate protection? Well, it is better than almost anybody else gets. So from that angle, yes. Somebody instigates a case and gets some false thing, that can happen even today. Even if you do nothing wrong, your neighbor, if he is powerful, might doesn't like you, he can get you in the lockup. So other than that, IPs are well protected in India. One thing here, we don't require mandatory insurance. In UK and others, that is required, that you have to actually take liability insurance.
Okay.
As of now, here it is not mandatory, but there is some policies which are there, people take, which covers the legal cost of proceedings which are related, not personal liability, but during the course where you could be a party as an RP. Other people involved in the process are not protected. There is no protection to a service provider. Special protection. The protection of the Constitution and the law of the land is there, but nothing special.
Thank you.
Okay.
Thank you, sir. Thank you.
Right. I think probably we don't have any more questions.
Tony, sir, Tony, any questions?
We are not. We don't have any more questions.
Okay.
Thank you very much.
That's it.
Yes, sir. If you share that PPT, we can post in our.
I will send it to you by WhatsApp or email.
Okay.
Yeah. Please send it to the branch email, and it will be made available at our website for all our members.
I will do.
Yes, sir. All the CP program online also we are recording, and we will be kept it in our branch website.
Okay.
Okay, sir. Thank you.
Thank you. Thank you a lot.
And Tony, please.
So it's our secretary's prerogative to propose a vote of thanks, and I'm deputizing for our secretary Salim A today. So it's an honor to propose a vote of thanks for this virtual CP seminar. First of all, I'd like to thank our faculty, eminent faculty member for today, Mr. Ravi Prakash Gandhi from Mumbai, for a wonderful session that has opened doors for us chartered accountants in the new areas of practice, that is the IBC. I'd like to extend, on behalf of the Ernakulam branch, I'd like to extend heartfelt gratitude to our speaker for today, Mr. Ravi Prakash Gandhi. Thank you, sir.
Thank you.
To the representatives of the managing committee, the chairman, CA Jose KV, and vice chairperson, CA Deepa Verghese, I extend my heartfelt gratitude. And the attendees for today, and CA Satishan sir, who has also came on and shared his insights on the subject. We thank you, sir. Thank you to Joe sir and Deepa ma'am, and all our staff at the Ernakulam branch who has facilitated this seminar. Thank you. Thank you, everyone. Have a wonderful evening.
Thank you. Thank you. Thank you, sir. See you. We'll meet again. We will keep in touch. Thank you, sir. Thank you, Sadish sir. Thank you. Thank you very much, sir. Yes, sir.